Dennis, always good to see you. Always good to get your take on the Fed here and what they are telegraphing. What do you think they are telegraphing? Is there anything below the surface, or is it really the message that each meeting is live and we're just going to see what the data tells us?
I think that's the message. I don't think they're telegraphing much at all because they don't know what data are going to arrive. But at first, I thought Steve's summary was really excellent, and I agree with basically everything Steve said a second ago. Powell repeated his mantra, which is we're getting used to now. It's meeting by meeting, data dependent, no predetermined path. All of those comments he said before, but he repeated them yesterday and really kept his options open and disclosed very little about anybody's thinking on the committee as to where this is going to go.
When we think about the markets and pricing in a rate cut in May, 60% chance of a 25 basis point cut next May, how should we think about that? Should we think about the economy turning south, therefore needing some easing, or do we think about that in terms of, the inflation target is close, and so they're going to go less restrictive?
Well, I don't know exactly what to take from pricing in that cut in May of next year. What I heard from Powell is some patience, if you will, or at least a recognition that getting inflation down to 2% is likely to take some time. I think he projected 2025 in his comments, and he also certainly did not give any indication that they will move before they're pretty convinced that they're on a track to that 2025 achievement of their goal. And then another aspect of this, I think, is that he, in so many words, acknowledged that the last mile, that's the term that's being used these days, the last mile is going to be more difficult than the progress made on inflation to date. So when I add all of that up, it just seems to me a May cut is wishful thinking to some extent.
Well, Dennis, I'm curious in what that last mile looks like and why it's perhaps more difficult. Can you explain to our viewers what the challenges are?
Well, in numbers terms, I would think of it as getting from a 3% run rate down to a 2% run rate, given the variety of indicators they're looking at. They're looking at a dashboard of inflation indicators. So what they take from that synthesis is essentially what's the underlying pace of inflation. And if that's around 3% and they want to get to 2%, that's the challenge. Now, why is that difficult? Well, it could be because we have some quasi-structural elements at work in our economy that, for example, chronic mismatch of labor demand and supply, which is going to continue to put some pressure on wages and cost of employees. That's an example. There's discussion, I think, in monetary policy circles of whether we are in a period of supply constraint as opposed to an era of plenty pre-COVID. There could be a number of reasons that just make that last mile harder.